Hey everyone, Meet Kevin here. Today we've got to talk about the Federal Reserve and, well, projections for what the hell is about to happen on Wednesday. And folks, preview, I don't think it's going to be good. That's because the Federal Reserve has a few big problems to solve, and I'm not just talking about inflation, I'm talking about the differences in what's known as the summary of economic projections. This Federal Reserve meeting is going to be different in that we actually get a summary of economic projections, which we don't get in every single Federal Reserve meeting. The last time we had one was in March, and then before that we had one in December, which means we missed January and May for these. These particular meetings are especially important because what they are is a projection of the board members' opinions on where the unemployment rate will be, where the recession potentials will be, where inflation will be. And a lot of these things have changed since March. So let's talk about these things. First, from March, or in the March release, the one that came out on March 16th, the Federal Reserve blew us away with their GDP projection. The market was expecting a 3.5% GDP read. They actually came in with 2.8%. That was a shock, and we saw a little bit of pain at the moment when that SEP report came out. And so what's fascinating here is I don't think anybody thinks GDP is going to be between 2.8% for 2022 and 2.2% for 2023. The reason is we're thinking there might be a recession. A recession would mean the SEP GDP should show some form of GDP closer to zero. And if we go negative, then we see a recession. Now, the cool thing about the SEP is we actually get a range of what all the different folks on the Federal Open Market Committee think for the recession potential. Last time, the GDP range for 2022 was anywhere between 2.1 to an optimistic 3.3. If now, imagine this flips and the ranges of GDP projection are like 2022 anywhere between 0.5 to 1.5%, huge revision down, and then 2023, potentially the ranges are negative 0.4 to 1%. The market's going to freak about that GDP change in direction. Really big problem. Now, there's a second problem here, though, and we got to get to talking about inflation and unemployment and the Fed funds terminal rate. But here's the thing that you really got to think about, okay? And folks, it has to do with the Fed's credibility. This is so freaking critical because back in the 70s, and this is what was different in the 70s, was that inflation was high for 6 to 10 years. It was over 5% for 6 to 10 years. And the Fed's like, don't worry, we may have left the gold standard, but don't worry, the inflation's transitory, don't worry, we'll get it down with just nominally higher federal funds rates. Well, what ended up having to happen? We ended up having to get Paul Volckered. That's because the Fed lost so much credibility. Nobody actually thought inflation was going to go down. When people don't believe that inflation is going to go down, they demand more pay and they buy more stuff now, which actually self-fulfills more inflation. That's bad. The Fed has to have credibility, which they do to some degree today, but they're losing it. You compare the Fed to the rest of the world, the United States dollar is the strongest. It's rising substantially over the past few weeks, especially if you compare it against like the Japanese yen. Failed monetary policy experience. What happens? The dollar gets stronger, which is actually bad for earnings at U.S. companies that are trying to sell to companies or people abroad because it's more expensive for them to buy products. You know, somewhere 52% of buyers of Teslas are foreign. That makes Teslas more expensive, right? Which potentially reduces demand. But anyway, point is, when we talk about the Fed, they have to maintain credibility. And unfortunately, because of their spat with transitory inflation, they don't appear to have very much credibility left right now. And so that's why, in my opinion, this next SEP report is really critical. See, if we end up having the Federal Reserve give us an SEP report that's sort of like, oh, hey guys, all right, we think GDP is going to go down from 2.8% at the end of the year. We actually project now that it's going to be like 2.4%. Well, everybody's just going to roll their eyes at the Fed, and then we'll have even less faith in the Fed. And I think the Fed realizes that. I think the Fed's going to realize that, okay, what we have to do this time is we actually have to make sure that we give a summary of economic projections that's reasonable. If we have an inverted yield curve, which is just inverted again today, the 10-2 Treasury yield curve, then we probably actually need to be honest with people for once and project a proper GDP forecast, because otherwise we won't have any freaking credibility left. At the same time, they're obviously going to warm us up to the idea of what the market's already starting to price in, which is a higher terminal Fed funds rate. And they need to do this, again, to maintain credibility. If they come up and they're like, oh, we're just going to go for 250s and then we're going to go for 25s again, nobody's going to think they're credible. So they have to give us bad news in order to maintain their own freaking credibility. They have to tell us we're going to go for what the market's saying, potentially 175 BP hike, whether that's in June or it's in July, followed by 50s. 25s are gone, 50s the new 25, and 75s are the new 50s, because we're not seeing that inflection down in inflation. They can't even pull the narrative that they were polling in March or in May, which is like, oh, there's some measures that inflation has peaked and it's trending down. Not after this last report. It's a complete freaking disaster. So, two big problems here, okay? And then we got to talk about these other things regarding inflation and unemployment and that. I'm going to summarize these two big problems right after I just mentioned that this video is brought to you by Public. If you want to get a free stock worth all the way up to $1,000, make sure to go to metkevin.com/public. And if you go to Public and sign up and deposit any amount of money, a company that does not use payment for order flow, they will give you $1,000 or up to $1,000 in free stock just for signing up. All right? Check them out via the link down below, metkevin.com/public. Okay. So, the two big problems. Again, number one, they have to give us bad news on the S&P, otherwise they lose credibility. And they have to give us bad news on the rate forecast because inflation just isn't transitory. That means all of a sudden, this whole idea that, oh, yeah, don't worry guys, everything's smooth sailing out there. Don't mind the hurricane out there. Don't mind any of that. All of that is just bull crap. The Fed's got to give it to us straight for once to maintain their credibility, because only if they are credible, will inflation expectations come down? And see, this is a concern. The last inflation expectations that came out Friday came out in such a way that, I should say they came out right before the consumer sentiment survey came out, which was a complete disaster, and consumers' inflation expectations actually rose more substantially than expected. That's bad. But wait a minute. If consumers' expectations for inflation shot up before inflation actually shot up in this last terrible report, that means the next outpouring or the next report on consumer inflation expectations could be even worse unless the Fed has substantial credibility. And again, they can't be credible if they keep telling us that, oh, everything's fine. They have to make us feel like Paul Volcker's coming, and maybe he won't. But this whole softest landing thing, they should kill that. Stop saying we're going in for a soft landing. I wish Joe Biden would do this too. They need to wake up and go, listen, folks, it's not all good. It's bad. We have a problem. You need to start saving money and get out of debt, and you're going to have a crap time if you're invested in real estate or stocks, and they got to be real with us. Because if they would just be freaking real with us, then people would actually trust them again. That's why this SEP is going to be so important. No more softish landing, because you know what? The softest landing is bullshit. All right. Now, we said that. We're good, okay? We got to now talk about the other problems in the report, because the other problems in the report are also a big problem. The unemployment report is going to be bad in this projection. I'm going to explain that. So here's what I mean with the unemployment report being bad. So when we potentially flirt with a recession, you see companies go bankrupt, like Revlon went bankrupt. That was terrible. And when companies go bankrupt, people lose their jobs. So we expect the unemployment rate to go up. But the Fed has only projected that the unemployment rate would tick up by 2024. This is more freaking Fed bullshit, and I'm tired of it. Oh, shit. Oh, scheisse. Oh, gosh. There's no ladder. Not like a beached whale over here. Oh, dear. Okay, look. Oh, this is the best plug for life insurance right here. Make sure to get yourself life insurance in as little as 5 minutes. Link down below. Go to metkevin.com/life. Oh, I'm going to not be pacing on the deck. Anyway, so where were we? Oh, the unemployment. So here's the thing. In the last SEP, they bullshitted us again, okay? They told us, thank God, I gotta tell you. They told us that the unemployment rate would tick up in 2024 first. This is bullshit. They're full of crap. They've told us many times that they need to, in order to get inflation down, lower inflation by raising rates, and that is going to lead to a tick up in unemployment, especially if you have a recession or depression, right? They need to be real with that in the next SEP report. The problem is, if they're real with us in the next SEP report, people are going to freak out again. So you've got a lot of potential freakout coming. You've got the change in real GDP. That forecast is going to be a disaster. I think the range is going to flirt with recessionary numbers, and they're either real with us and it flirts with recessionary numbers and everybody freaks out, or they lie to us and everybody freaks out because they're not credible. And that's even worse. We need them to have credibility, which means we need to stop the bullshit and wake up. The Fed funds rate. Okay, the terminal Fed funds rate. Oh boy, this one's a disaster, okay? So the last projection for the Fed funds rate at the end of the year was 1.9%. The Fed told us, we need to get above neutral. Neutral is when we're not constrictive or accommodative. We're neither of those. That's about expected to be 2.5%, though nobody actually knows where the neutral rate is. Fine. Well, in the last SEP, they told us they would get to 1.9%. Now they're telling us, we think we're going to go a little above neutral, which would imply a terminal rate of somewhere between 2.75 to 3.25%. You don't even want to know what traders are pricing in right now. I'm going to tell you, right after I mentioned that, folks, seriously, build your first million, become a millionaire in real estate. It's much more stable. It's much more predictable. You don't have to try to time the market as crazily, although there are opportunities in the macro real estate cycle to make a lot of money. The real estate cycle is slow and it's very predictable. And in my opinion, especially with mortgage rates now touching 6% after the 10-year skyrocketed, you're going to have some really sick opportunities to make money in income property investing in real estate. That doesn't mean that if you're a homeowner, you should freak out and dump your home or whatever. It's too expensive to worry about that. But you should be lowering your debt and preparing, getting educated. How am I going to find wedge deals? Where am I going to buy wedge deals? How am I going to get wedge multifamily deals? What's the difference between a wedge rent deal, a wedge condition deal, a wedge O deal? These are all very important things. If you don't know these things, seriously, check out the programs linked down below on Building Your Wealth. 0 to Millionaire Real Estate Investing. I guarantee you this is the most comprehensive program that exists out there on real estate. Nobody continues to add to their courses except for me. I add to my programs, especially when times change. And folks, there's a bunch of flipping courses out there. The last thing you want to do is flipping. Focus on a real product, and that's what this is. That's why I'm so proud of always being able to sponsor myself and my channel, because it's what I believe in the most, is myself and my ability to provide you value. So check that out, link down below. There's some other real estate programs as well if you're in sales or you want to learn do-it-yourself property management or my tricks for rental renovations. But folks, the terminal rate that traders are now pricing in for the Fed funds rate is 4%. That means on this next SEP, if the Fed wants any freaking credibility, we got to drive, I forgot. If the Fed wants any credibility anymore, anything, oh, let me get my glasses over here. If the Fed wants any credibility, they're going to have to update the SEP terminal rate, and that is also going to freak out the market. So the terminal funds rate or terminal rate for the end of the year, again, was expected to be 1.9%. My expectation is in this next report from the Fed, we're honestly probably going to get something like 2.8 to 3.2% by the end of the year. That's also going to freak the market out. So look, you're going to have low buying volumes between now and the Fed meeting because people don't like uncertainty. People freak out over uncertainty, and I would expect low buying volumes between now and the Fed meeting. But when we get the Fed meeting, I also think we're going to experience a disaster. We're going to be in a situation where when we look at that SEP, we're going to go, holy crap, this is the Fed trying to regain the people's trust, trying to regain the credibility. And look, I'll tell you, as much as you might hate the Fed right now, at least we have, some regulation and a Fed and institutions that, try to solve problems when they come up, which is what crypto, unfortunately, does not have. And that's why we started this whole stablecoin disaster, which we've been talking about potentially happening since the end of 2020 on this channel. I've always said stablecoins, I don't understand them. I don't understand why. I understand them, but I don't understand how they're not rehypothecated with no regulation and how that's okay. And that, unfortunately, is now affecting what's actually a really good technology, blockchain technology. I'm a big fan of blockchain technology, but I'm very concerned about the future of an unregulated environment. And I don't want to come across as like a Fed shill. I think they effed up here. I really think they effed up. And that's why I think they're going to have to regain credibility. This is not going to be like a Paul Volcker, but it's kind of like, this is like the pre-Paul Volckering. Anyway, folks, I wish you the best. I seriously do. I'm always here for you. And I'll keep you updated. Check out those programs linked down below. I'm going to head back and do a course member live stream now. And look forward to talking to you all soon. Thanks. Bye.